You know the feeling. You are so busy. You have a full book of clients, a mile-long to-do list, and a growing team who is supporting you in growing your business. But you don't know where all the cash is going. Why don't you, air quote, feel like you have more money in your business? You're listening to Business by the Books, the podcast that teaches you how to use your financials to manage your business. My name is Danielle Hayden. I'm the founder of Kickstart Accounting Inc., where we use bookkeeping as a vehicle to help business owners take control of their numbers. I've helped thousands of entrepreneurs make informed financial decisions for over a decade. So today we're going to be talking about why you feel productive, but you're not actually profitable. You're going to walk away with 3 specific things. What is an income statement and how will it help you? The common mistakes business owners make when growing their business, and the process I use as a 7-figure business owner and former CFO to increase profitability. We recently worked with a client who was so excited to finally see her numbers. She had came to us midway through the year, so we did what we call a catch-up, the process where we put all of her transactions into QuickBooks so she can see exactly how her business is performing year to date. Now, she was so excited because she was rocking with new clients. She had recently implemented some new service offerings, and she was bringing on new team members to support her growing client base. She was so busy with not enough time to get everything done that her growing business needed from her and her team. Now, you can only imagine how devastated she was to find out that she was not profitable. Now, there were so many things that contributed to our client's loss, such as an increase in supplies. She had become an S Corp this year. This was the first time she was ever on payroll, and she was growing and training her new team. Now, her biggest regret was waiting so long to see the numbers and the full impact of her decisions, the way that her decisions were impacting the health of her business. She was so sure that her full book of clients meant that she was profitable. So what went wrong, right? What exactly happened to our client? And how can you learn from her mistakes to make sure that this doesn't happen to you? Now let's rewind. Let's start with the basics. What is an income statement? An income statement is also known as a profit and loss statement. So you'll hear me kind of interchange those terms quite often. So income statement equals profit and loss statement. This is a financial report that you can export from any accounting system that you use. And it has the company's revenue, money in from your clients, and expenses, money out over a specific period of time. It helps you understand how well your business is performing by highlighting your profits and your losses. Now, this report is actually what you'll use to pay taxes at the end of the year as well. Now, there are a few key components to an income statement. I am going to share my screen. So if you are listening on YouTube, you can see us walk through this together. Now, the first area of the income statement is revenue. This is a total sum of all of the sales coming into your business. Now, most of our clients, most small business owners are operating their business on a cash basis. This means that the time that the money hits your bank account, so the time that the actual deposit hits your checking account, this is when it is considered a sale. This is when it's considered revenue in your business. So total revenue is total cash in the door. Next, we have our cost of goods sold. Now, for most of our clients, this can be an area that can cause a lot of confusion. These are the direct costs for the supplies you need to serve your clients, or if you're a product-based business, the actual material, the inventory that you are selling to your clients. So this right here, in my example, our cost of goods sold is labeled as supplies. Next, we have the operating expenses of the business. This is all the other expenses that you need to pay for in your business to operate as a business. You'll see here that this includes things like advertising and marketing, It includes facility expenses, fees, outside services, payroll, training, and travel and entertainment expenses. So these are the major categories that we use to break down our income statement as part of our proprietary framework here at Kickstart Accounting. However, yours might look a little bit different. We break ours down into those larger categories and then have specific accounts underneath to help break down where clients are spending money. So you can see as we go through the income statement, the different breakdown of expenses. Now, I've highlighted here in yellow the most important number of the entire income statement. This is your net operating income. This tells you whether or not your business is operating at a profit or operating at a loss. So if this number here is negative, you are operating at a loss. If this number is positive, you are operating at a profit. Now, not all profit is created equal. We don't want to see you at 80% profitability because you're probably not appropriately staffed or appropriately paying yourself. A really healthy percentage is 15% profitability. So you can find that by this percent of income. All right, so how is productivity impacting our profitability? Now, productivity is all about efficiency. It's how well you're producing the goods or delivering your service. Remember, profitability is all about the financial gains. It's how much profit or money your business is making. Now, the common mistake, so many business owners, like seriously, you are not alone. I've done this. Our clients have done this. It is a common mistake. It assumes that high productivity means high profitability, and that's just not always the case. Now, back to my example at the beginning, our client who has the full book of business, she had high productivity. She was serving her clients, serving her team, and growing her business. But she was not serving those clients at a price that covered her costs, right? We need to see enough clients that cover our team's cost. And this includes not just salary, but taxes, benefits, PTO, internal downtime, training, the facility costs, and advertising costs to bring new clients in. We will not have enough revenue or cash to cover the cost of the total business if we are not charging our clients enough money. So high productivity and a growing team can lead to high operating expenses, which eat into your profits. So let's take a closer look at this and see how the different parts of the income statement relate to productivity and profitability. We'll get back to the show in 1 second, but real quick, are you a business owner feeling overwhelmed by your finances? Do you find yourself wishing you had more control and understanding over your money? Managing your business finances can often feel like navigating a ship through a storm without a compass. But what if instead you could master your business finances in just 5 days? With the confidence to manage your money, make informed decisions for financial stability, and implement strategies to increase your profitability effortlessly. And that's exactly why the 5-day video bootcamp was created. It's a comprehensive course designed to empower you with the foundations for financial success. Throughout the bootcamp, you'll learn the foundations, how to manage costs for profitability, evaluate investments for growth, and avoid common financial pitfalls. So if you're ready to take charge of your financial journey and rewrite your success story, head over to esuite.co/5-day bootcamp or click the link in the show notes and sign up for the bootcamp today. Okay, back to the show. Revenue can really be a vanity metric. Revenue reflects the business productivity. It shows how much money you're bringing in. But remember, revenue doesn't consider the costs that are associated with generating that revenue. It doesn't give you the full picture of profitability. So you can see here, our client brought in $250,000 between her core sales and her services. Now, remember, revenue is not taking into consideration whether she is seeing those clients, if her team members serving those clients, what is the downtime that she is spending or her team is spending, how much money and advertising and marketing costs did it cost her to bring in every single one of those clients, and what supplies were needed in order to service those clients. That's why I really consider revenue to be a vanity metric. We hear so much buzz on social media about getting to 6 figures, getting to 7 figures. But I have found in my experience that as we grow in business, we need more support. We need a higher level team. We need management for our team. We need more operations, systems, and tools in order to be really effective. So as we grow as a business, we might not be as profitable. All right, next is our COGS. Managing our costs or our supplies is so crucial. If your COGS are too high, it immediately eats into your profit and diminishes the amount of money, the amount of cash that you have in order to operate your business. Now, here in this example that I have for you, our client's spending about $25,000 in supplies. It's only about 10% of her revenue. Usually we like to see this under 30% so that you have enough cash, enough money in order to operate your business. All right, next we have our operating expenses. Now, high productivity can lead to high operating expenses. Remember, our growing business requires marketing costs. There might be team members who aren't at 100% capacity. A growing team does not always mean that they're optimized and they're working efficiently. As our lives as business owners and our team's lives change, we're going to need to offer team benefits or PTO. Our situation as an owner changes. So we might be on S Corp, meaning that we're on payroll as a business owner. We might have new systems for client experience. So our operating expenses are going to contribute to the overall profitability of our business. Now, remember, just because you're productive doesn't mean that you're going to have the profitability. So here in advertising and marketing, our client is spending about 7% of her sales in marketing and advertising. And honestly, guys, this is spot on. We want our clients to be spending between 8 and 10% of their revenue in marketing costs so that we can bring clients back in the door, make sure that our team is operating at 100% efficiency and capacity. Now, if we are in high growth mode, we might be spending 15 to 20% of our sales in advertising and marketing costs in order to get that boost in the door. So I don't want you to take this as this hard and fast rule that we can't go over. Our costs are going to fluctuate from time to time. If we have new team members that we need to build their book of business, we might have higher marketing costs temporarily until that evens back out. Next, we have our facility costs. Now, this client is spending about 8% of her sales in facility costs. This is okay. We actually want to see clients spending less than 10% of their sales in facility costs. Now, this is going to change if you are in a growth mode business. So maybe you have a larger facility that you are occupying today with the intention of growing into it in the future. So again, not a hard and fast rule, but we really want to see our clients under that 10% mark for facility costs. Now we'll go into the other business expenses. We want our operations expenses to be about 5% of our total sales in order to operate our business. Now remember, as we're making tests and changes in our team and in our business, this is going to fluctuate. Here at Kickstart, we've had a huge fluctuation in our operating subscriptions. We have invested heavily into software here in 2024. And so for us, this cost is actually much higher this year, but we know that it's going to create efficiencies for our team and it's going to improve the customer experience for us long term. We want to invest in the right tools, software, and subscriptions that are going to help our productivity. So as our costs increase in operations expenses, we want to have an increase in productivity. Now, our outside services, I want to make sure that every single one of you have outside services. This is going to include team members like your money team, your bookkeeper, financial advisor, accountant, CFO, business coach, your attorneys. These are the people who sit as experts outside of your business. Unless you're an accountant, unless you're an attorney, you are not an expert in this area. And it's really important that you have costs for this in your business to get the support from the experts that you need. You can go back to the hiring series that we did. I'll put the link in the show notes. All about buying back your time and how to buy back your time with experts until you're ready for employees and to become an expert on your own. All right. Then we have our payroll expenses. This is huge, especially for our client here. Now, our client has 75% of her sales going out in payroll expenses. This was a big year for my client. She had become an S Corp this year, which means that she needed to put herself on payroll. And she is required by the IRS to pay herself a reasonable compensation. Now, in her state, she had to pay herself $75,000 a year because that is what it would cost her business to replace her role if she wasn't the one working in this position. So she worked with our KSA Tax Partners team in order to get a reasonable compensation analysis completed. So she knew she needed to pay herself $75,000. Now, she was an LLC before, taking owner's draws, which means it wasn't on the income statement. Owner's draws are not a business expense. You do not pay taxes on your owner's draws. This is a big change for business owners who are becoming an S Corp because you are now, for the first time, contributing to the profitability of your business. Now, for our client here, you can see that $75,000 is actually 30% of her sales. She also has a growing team who is not operating efficiency and is not at 100% capacity yet. And she is paying her team $85,000 a year, which is 34% of her sales. Now, unfortunately for this client, she's actually operating at a loss. She's operating her business at a 10% loss, meaning that she lost $24,000. Now, this means that the cash balance of her business is down by $24,000. We need to be looking at the income statement and making small pivots, right? We don't need to make drastic changes to overcorrect when we're looking at the numbers. We need to look at the productivity of her and her team to decide how we can make small changes to right the ship over time. Now, my client here is going to keep on looking at this report right here, this income statement year to date as a percentage of income, to look at the impacts that her small changes are making over time. So balancing productivity and profitability does require strategic planning and regular reviews. So I want to leave you with 4 final tips. Align your goals. Set goals that balance productivity and profitability. Focus on both efficiency and the financial outcomes of your business. You might be in a high growth season of your business. You might be heavily investing on marketing costs. You might be building a team, training your team so that you can support your personal goals. So know what your goals are and how your financial investments are aligning to those goals. Monitor your financials regularly. I want you to commit right here, right now, to reviewing your income statement every single month to monitor your performance. Keep making those informed decisions. Don't be like my client who's operating on gut feel only, who felt busy, so she felt like she must be profitable. I want you to manage your costs. You do not have to sacrifice productivity. You do not have to sacrifice your time to manage costs. You can look for ways to reduce expenses while maintaining the quality of your life and your customer experience. And then invest in efficiencies. Invest in the tools, technologies, and people that are going to improve your efficiency in your business. This in turn will help you increase productivity without significantly raising your costs. Now, all this information is only good if you go put it to use. I want you to pull out your income statement, pull out your percentage of sales report, see how your financial results compare and how you can align your goals and your productivity in your business moving forward. I have a favor to ask. If you have gotten any value from this show and you want the show to continue to grow and keep providing you with strategies for financial growth and efficiency, simply leave us a rating and review if you're listening on Apple or Spotify. Those reviews really go a long way in attracting more listeners, and honestly, they really make my day. So if you're feeling up to it, we'd love to see a rating and review from you. Either way, thanks so much for listening to the show.